Our third and final topic, lessons learned and looking forward. We are now into November and 10 months into COVID. What lessons have we learned thus far in 2020?
One of the lessons I suppose that we learned is that people are more flexible than we might have thought. We really had an enormous transition in society. People all of a sudden stopped going out. People became nervous about things as simple as riding the subway or going up an elevator, and yet they adjusted their lives. At the same time, we saw businesses adjust very quickly. Supermarkets transitioned to packing your groceries for you and delivering them, something that had never happened before. Restaurants transitioned to a takeout model. Most commercial businesses transitioned to work at home. So I think the thing that surprised me the most is that the economy didn't take a bigger hit than it did because people turned out to be so flexible.
One of the greatest lessons that I learned in 2020 is that great companies, great management can adapt to crisis. We've learned that businesses such as Disney, where their theme parks were closed, were able to focus more on streaming. We learned that Netflix, for example, which wasn't able to shoot any productions, had quite fortuitously created lots of movies and TVs well before the pandemic. We also saw businesses, for example, that were focused on work from home and technology absolutely benefit and able to pivot and meet the demand for businesses and people that really needed to get access to technology to meet their everyday needs. And we saw retailers like Costco and Loblaws be able to supply goods and benefits. So the greatest lesson that I learned is, no question, the initial knee-jerk reaction when a crisis hits is to sell everything or to run and panic. But really you have to use what we call second-level thinking. And maybe some companies will actually benefit from a pandemic. Maybe some companies' management will be able to pivot and figure out ways to benefit their businesses as well as help out their customers. And so that's a strong lesson that I learned in the pandemic crisis.
So I think another lesson for investors is that by definition, a market panic is going to be something that was unexpected. I think too many investors leading up to COVID, they were preparing for a repeat of the 2008 financial crisis or the 2000 tech bubble, when in reality, it was much more likely that whatever negative event was going to happen was something that you had not anticipated. This is what the definition of a black swan is. And so I think from an investment perspective, what this really means is that instead of trying to predict what might or might not happen on a macro level, just really focus on the quality of the companies that you're owning.
Given your views on lessons learned, will Baskin be making any major changes to its investment strategy going forward?
What we've seen in the last 9 months since COVID hit was a very sharply differentiated model in the markets. Some stocks, which we've talked about, the stay-at-home stocks, particularly the large technology companies, did tremendously well, whereas other industries, banking, for example, real estate, things that we traditionally have seen as the safe sectors, haven't done well at all. I think as we go back to normal, some of the things like banking should be more of a focus for us. We should look to get more money into those sectors and perhaps take a little bit of the money off the table in technology that has been so successful. But the main thing I think that we know is at the end of the day, good companies are where we should be invested. And we're very satisfied that our portfolio is full of good companies.
Well, we are very pleased with our clients' portfolio performance in 2020. Prior to COVID, we had already focused our investment strategy on owning the highest quality companies, as well as diversifying our clients' portfolios across several different industries. No question our clients owned a number of businesses that were hurt by the pandemic, but they also owned businesses that thrived in this environment and will be structural winners for many years to come. So we think ultimately the investment strategy of buying and holding the highest quality businesses that we can find, companies that have strong reinvestment opportunities, companies that have great management, terrific balance sheets, generate lots of free cash flow, is the right way to invest. And given the performance in 2020 and how well our company's done, it's made us even more confident in our current investment style.
So the short answer is no. If anything, what COVID has really done is validate our investment strategy of investing in great businesses. And if anything, we should have leaned more into that even leading up to COVID. So for example, we were lucky enough to have sold travel-related companies and airlines and movie theater stocks in the months and days leading up to the COVID crisis, and invested these proceeds into major technology companies like Netflix and Activision Blizzard. But we could have done that even more, and our performance would have benefited has benefited from this tactical shift, and will continue to benefit, and we will continue to look for ways to invest in great businesses that are going to continue to grow irrespective of the election cycle and irrespective of whether society is going to reopen or not.
My final question has to do with interest rates, which will stay low for the foreseeable future. What is the right asset mix to achieve a reasonable rate of return in a low interest rate environment?
Low interest rates make stocks more attractive. Right now, savings are paying almost nothing. Even bonds, as long as 10 years, are paying less than 1%, and that's before taxes. That means that most investors have to be in stocks. Investors seeking income have lots of choices available to them right now, including telephone companies, utilities, pipelines, and banks. Those seeking growth can be confident that they can pay more for growth stocks right now simply because the alternatives are so unattractive. So we think that the market is still going to offer many opportunities, and the Federal Reserve Bank, the Bank of Canada, the European Central Bank have all told us that interest rates are going to stay low as far as the eye can see. This makes investing in equities an easier and more attractive proposition.
No question, a lot of our clients depend on income from their portfolio to meet their monthly expenses. As well, not all clients want or require their entire portfolio to be 100% invested in equities. As a result, our clients are invested in bonds through the Baskin Wealth Fixed Income Bond Pool. That has actually performed quite well in this crisis, but we are not interested in exchanging return for risk. The returns on bonds, the returns on cash, the returns on GICs, as we all know, are so low right now in this environment. It is very hard to achieve a great rate of return. But that doesn't mean that we need to take on more risk to achieve higher rates of return with fixed income. We will stick with the highest quality bonds we can find and try and keep a very diversified portfolio and not try and chase yield. We are more than happy to accept volatility with our stock portfolio, but we will not take on any risk with the bond side of our portfolio. Low interest rates are great for stocks. They make the value of a company that generates strong cash flows worth all that much more. And we all know that when bond yields so low, with interest rates so low, that it's hard to achieve a great rate of return. So we've had to increase our clients' allocation slightly to equities to achieve reasonable rates of return. And we think that's appropriate as long as our clients understand that by owning more equities, you are subject to the volatility of the stock market.
So I think I would caution investors not to be too sure about their forecasts of what interest rates may or may not be in the future. But I will say that as long as interest rates are going to continue to stay low, I think, again, this really just speaks to our strategy of investing in great businesses that have the opportunity to invest their cash flows at very high rates of return.
I hope that you enjoyed our roundtable discussion, and I thank you for spending time with us. If you have any questions, please reach out to your portfolio manager. And if you're not a client of Baskin but would like to learn more about us, please visit our website or give us a call. Stay safe and be well.